In this video, we'll use the Crypto.com exchange arbitrage bots. I'll explain exactly what these do, why you'd want to use it, and some of the considerations here, including explaining what exactly an arbitrage bot does under the surface to actually gain the yield that it says that it gives. So if we go to Crypto.com exchange, it's in bots here and then arbitrage bot. Now, Crypto.com exchange isn't available in every region. Some regions don't have this yet, although it is coming to other regions, I think. So you'll have to check if the exchange app is available for you. It's actually the same login if you have a Crypto.com app account. It's exactly the same login. You can just come in, log in with your existing details if it is available for you. I'll leave some links below to the exchange. You can get 5% fee discount from that link as well. If you don't have an exchange app yet, you can just go through and get the 5% fee discount. So trading bots, popular arbitrage bots right here, and we've got estimated APRs. What is exactly happening here? Well, an arbitrage, of course, is where you can take money out of the market with potentially taking no or very little risk. In terms of arbitrage bots, there is risk, of course, in everything, but specifically the arbitrage relates to the yield that we're getting out of our market risk position. So these arbitrage bots actually carry out what is known as a delta neutral trade. That just means that we're attempting to not take any directional price exposure to the assets themselves. What we're trying to do is arbitrage the difference between two markets for the same asset in crypto. And we are essentially canceling each other out. So we buy and we sell the exact same exposure, which means that if the price moves, one of them wins and one of them loses, but overall we're actually net the same, which is known as delta neutral, right? So our price exposure is neutral, delta neutral here. But because of this, what we're doing is trying to earn this yield out of the market, and I'll show you exactly how that works. So the way arbitrage bots work, there are different versions of this, but on Crypto.com exchange, essentially what we're doing is carrying out the spot futures funding arbitrage. So let me explain that. You buy in the spot market a crypto asset. So you buy $1,000 worth of the asset. You have long exposure, and so you have price exposure because you're long. So you can make money when the price goes up and you can lose money when the price goes down. That's not what we want to carry out an arbitrage. So what we do with that long, let's say we take 1 unit long of that, we need to then take the corresponding sell trade. Now, if you just sell the spot, then you've just got cash, right? So that's no good. So what we do is we go over to the futures market, which is the derivatives market, and we can use collateral in cash to sell the futures. So in the futures market, you don't have to sell the asset. You can take a long and a short position, which is price exposure going up or going down, right? And so you can bet on that, either going long, so you benefit when the price goes up, or going short, and you benefit from the price going down. So we can do that in the futures market. We don't need ETH to sell. We can take a short position. So we go 1 unit long in spot, and we go 1 unit long in futures. And therefore, our trade is known as delta neutral because we're long one and short one. So essentially, if carried out perfectly, you have no real price exposure. So that's how the delta neutral part works. Now, the fun bit in crypto is you can see this APR, right? The estimated APR, you can see that down here. In fact, there's a list of assets that you can carry this trade out for. And you can see the estimated APRs range from 6% up to 48%, right? So there are different assets and they have different yields. Why is that? So that is because in the futures market in crypto, there is this thing called funding. Now, funding is a way to keep the futures price in line with the spot price. They're actually different markets, right? But the futures price is supposed to track the underlying asset one for one so that people in the futures market can have a reliable market to trade and go long in futures. Now, there's reasons why they trade futures, but that doesn't matter for us for this video. In any case, if lots of buyers are coming into the market and pushing the futures price up, that means they pay a fee to the other side of the market, which is short sellers, because they're pushing the futures price up and making it higher than the spot price. That's not good because that distorts the market. So they have to pay a kind of fee in order to go long because they're distorting the market. So they pay that fee to the other side. The other side gets the incentive to sell and go short to push the price back down into the underlying spot price. So when buyers are coming in, that's funding positive, and that means you get this, they call it APR on crypto.com, but if you think of the underlying what's happening here, buyers are coming in, forcing the price higher, they're paying a funding fee to short sellers. Now, that funding fee can also go the other way. If sellers are coming in too much and forcing the price lower in the futures market versus the spot, those short sellers have to pay funding as well. Now, that is a risk that we carry in this trade. This funding isn't just all of the time positive. Now, for crypto, it is most of the time positive, but there are occasions where it goes negative as well. And that is a risk that we take in this trade. It's not risk-free. Nothing is risk-free. What are the risks? Well, you have the funding rate risk potentially going negative. You have centralization risk over crypto.com, but to be fair, pretty reliable exchange, right? So it's pretty low down on the list, but some things can go wrong for sure. So there's all that risk that you have to take into account. However, just from a trade point of view, what we're doing is trying to essentially take a delta neutral trade, so no price exposure, and we're trying to cream whatever the funding rate is out of the futures market. Now remember, we're going long spot and short futures. So that means this works for us as long as funding is positive, right? And it actually doesn't matter what assets that we're trading because we're supposed to not have any price exposure. So it can be ETH, it can be Bitcoin, it can be some altcoin. And to be honest, altcoins may tend to have much higher funding rates over certain periods. Because if you think about it, these altcoins are more volatile. And if they do have a move to the upside, people pour in, they speculate, push the price up, and then the funding rates can get much higher. So it depends what asset that you want to trade. Now, the altcoins can be more volatile in terms of this APR as well. So you may have like a 6-week period where a certain altcoin is being bought up and the funding rate goes crazy, like this one right here, 37%, 35% you can see here, right? But the next 6-week period, that coin may not be traded as much, and so the funding rate may just come, kind of flat. So you may have to switch between them. If you want some more mature assets, the funding rates are probably not going to be as volatile, but slightly more reliable. So you can see ETH and BTC here much lower, 8 and 6%, but that might be a lot more reliable over time. So it's up to you which one you want to trade. But I want to hammer home that just from a trade point of view, it shouldn't matter which assets that you're trading. It just matters where traders are and which assets they're pushing up in the futures market so that we can take that short position and benefit from the funding that they're paying. The only other consideration before getting into an arbitrage bot is that there is an opportunity cost here. So the time when funding is highest is usually in a bull market, and that's because you have more people coming in wanting to speculate on the price going higher. They want to trade futures to the long side, which pushes the price up, which means that we tend to get these higher rates. During bear markets, you may not get as many buyers pushing the prices up, and so funding rates may crush a little bit. This is essentially taking a kind of dollar exposure trade, because you're putting dollars, stable coins, into the trade, and delta neutral means that you're expecting a dollar out. And so what essentially you're doing here is just earning an interest rate, as you can think of it. It's not interest, it's the funding fees, but it's a rate on dollars. So you're not getting any price exposure. Now, during a bull market for crypto, these things can move up 500%. And if you're getting, 8%, you're missing out on the bull market. Right, so that's opportunity cost is for sure there, right? There are other strategies as well, or assets that you can invest in. There are some protocols now that actually do this and carry out this funding rate across the whole market, and you can basically just buy into that strategy, and it gives you the assets. Now, there's some other risks there because you're relying on a protocol to do it. You're relying on a team there basically carrying this out and trading that and making sure that if you want your money out, you can get it out in time. And so I would actually prefer to do it on an exchange like crypto.com, where I'm just relying on my trade and I can get out when I want. I don't have to rely on any other protocol. So what we can do is press create now. So let's say we want to go into a BTC. So we press create now, and we can put an amount in that we want to trade, right? So what we're doing, as you can see here, is we are buying, and you can trade any of these pairs, right? But what we're doing is buying BTC USD in the spot market, and we're selling BTC USD perpetuals. We are then getting that funding rate, and you can see the funding rate APR is 8%, or over 14 days it's around 8 to 11% like that. This is known as a positive carry trade because we're selling the futures, we're getting the positive carry. The funding rate is positive, and so that's coming to us. Put any amount in here, just press proceed, and you open up that trade. Now, if you want to get out of it, that will be in your crypto arbitrage bot screen, and you can just get out of the trade. And what it's going to do is essentially close both ends of that trade at once and get you out and return the dollars to your account because you're putting USD in here. So you put USD in, you are expecting to get more or less the same amount out plus any interest or funding rate that you're earning.